Hey everyone, welcome back to another video. I think the last week must have been really frustrating for a lot of people. Seeing the market go up, go down, go up, go down. It is a roller coaster in this period of time, right? And I think, it is not easy to trade in 2026. 2026 is difficult. Um, but again, stay invested and study the data, study the fundamentals, and that's what's important. The Nasdaq entered correction territory, and a lot of the software names, the Magnificent Seven names, they're all down a lot, right, over the last couple of months. So if you really watch your portfolio, if you're invested in these stocks that are in growth, you already know that it's ugly, right? You know that it is frustrating, and a lot of people are asking, hey, is tech broken? Is this the beginning of something much worse, or is the market just, throwing a tantrum and panicking? So today I just wanted to cover that. We're not going to guess, right? It's here. We're just going to look at data, and then we're going to look at some names that I believe are generally worth watching if you think that the sell-off has gone too far. Right. So let's start with the facts because it is not a nice picture. It is ugly, right? If you look at the Magnificent Seven, you see companies like Tesla being down 25%, Microsoft 31%, Meta 20%, so on and so forth. Right? It is all down double digits from their all-time highs. And the Nasdaq 100 has officially entered correction territory. Right? When we say it's correction, it's something that is down more than 10% from its high. And not just stocks itself, but again, oil is sitting at $108 a barrel right now, driven by the Iran conflict. And this is crucial, right? Because for a tech company, the chance of higher oil lasting for extended period of time means that there's higher inflation risk, and the Fed is going to continue to stay hawkish, which means higher interest rates, and higher interest rates are not good for growth stocks, right? If you add to this, you came into a year that, frankly speaking, you look at these companies, their valuations were a little bit stretched. The Shiller Cape ratio, which is a measure of how expensive the market is relative to earnings, hit 39 times at the end of last year, right? These companies have ran up a lot. So for me, of course, yes, the sell-off makes sense on surface. Companies that have run up so much, obviously they will pull back when there's a correction, right? And the bears, of course, have real ammunition here. So let's talk a little bit again why this is happening, right? So there are three factors that I think makes a lot of sense. Number one is valuations, right? For this tech stocks that we have been in for the Magnificent Seven, they have been pricing for years of perfect execution, right? We are pricing them to constantly grow their revenues, constantly grow their free cash flow. And if there's anything that is, worrying, slightly wobbling, even the market, the compression is brutal, right? They will sell off. It's just math, right? If you look at how this is happening, you can see that's what's precisely happening in this month of March. And the second one is again the biggest question, which is the return on investment on AI. Sorry, your companies such as Microsoft, Amazon, Google, they are committing hundreds of billions in capex expenditure, right? Markets are asking this question: what's the return on investment? You spend all this money, you better make sure that you are generating more revenue, more profits, more cash flows for your shareholders, right? If you if there is no return investment, this is very difficult for the investors to stay invested because the question is, okay, fine, you have talked a lot on investing. We've talked about AI being the future. We've seen a lot of demos and a lot of roadmaps, but we need the actual PML impact on the financial statements. So with this, the uncertainty is shaking out investors, right? Even though the underlying businesses seems to be growing, people are asking more and more questions, right? That's why if I look back at the stocks, you would see that actually um Apple hasn't gone down as much as compared to some of these other names. Right? Because actually their capex investment is not that scary compared to the other companies such as Microsoft, Meta, for example. Okay. And the other thing here is on the macro headwinds, right? This conflict needs to have a resolution. The conflict is there is no resolution in sight. It seems like President Trump wants to do a ground invasion. It will be very detrimental if it happens, but the Fed is holding rates. The Fed doesn't know what to do. They're just holding rates. They're signaling patience. You look at Treasury yields and they're spiking. All these things is, hurting the growth, right? And that's why you're seeing such a sharp drop from December to now. And the Nasdaq peaking in December, it's been grinding lower and lower, right? In fact, my belief is that the sell-off can continue to extend if there is no resolution, right? President Trump is meeting President Xi sometime in May. So hopefully we get that resolved. But otherwise, we will see the stocks getting more and more compressed. But again, it is important to look at the companies and compare them to the dot-com bubble, right? Because there's a lot of comparison, and this is always being a talk that, hey, look, this is a dot-com bubble, it's going to crash, etc. But if we just look at the data, we look at the metrics, and we know that it is not exactly true, right? Uh, if you look at the P ratio at the dot-com peak, the average P was 85 times. Today is roughly 28. Back then, a lot of the revenue, it's also projected growth, projected of hope and hype. But today, if you look at the S&P's 500's revenue growth, actually there is growth. It hit 8.4% in Q3 last year. Free cash flow margin, if you look at it for those companies in 1999, they weren't making close to zero free cash flow. Today, your mega cap tech companies generates enormous free cash flows, right? For example, Microsoft operating margin being about 40%. So these are companies that are proven and actually profitable. They are not speculative websites, right? That were burning through funds, venture capital, for example, right? So to me, the point here is that in 1999, many of these darlings had no earnings at all. But today, for these companies, analysts are forecasting 13 to 15% EPS growth. So the businesses are fundamentally different. It's cheaper, it's more profitable, and there's growing real revenue. But the problem here is that the bad case is that it's the earnings for these companies. If we enter a recession, if oil prices continue to increase, hawkish Fed, and even in the worst case, if we get a rate hike, these companies, these tech earnings will get destroyed, right? If the earnings collapse for this Magnificent Seven, it is going to be disastrous, right? So the real risk is earnings and not valuation. But here is where you know, over the last few months, I've been looking around and I feel it's a bit uh contradicting, right? And it's a little bit underreported. there are two, if you look at all the news around all the headlines, there are two completely separate bear narratives that's driving a lot of the sell off. And these two narratives cannot be true at the same time. It doesn't make sense. So narrative number one is AI capex is wasteful. It is a huge outflow of cash. Doesn't make sense. The argument is all these hyperscalers are burning hundreds and billions on GPUs, data centers with no clear ROI. Right. So people are saying that okay, AI spending bubble, blah blah blah, demand will weaken, compression will continue. And then they have another opinion that narrative number two, AI is going to kill software as a service stocks. Right. And I think Palantir CEO even went on a interview and declared that AI is so capable, it's going to make traditional software companies irrelevant. Right. And that, you can see the obliteration of the SaaS stocks. You look at IGV is being crushed. And this is counterintuitive. You guys see the logical problem here? So if AI capex is wasteful, meaning to say AI isn't powerful, it's not productive, at the same time, how can it destroy the SaaS industry overnight? It doesn't make any sense. Right? You cannot have AI that is too weak to generate ROI and then strong enough to make decades of enterprise software obsolete. So companies like ServiceNow, like Salesforce, they are just selling off non-stops. Right. So these two narratives are mutually exclusive and doesn't make sense. Internally, it's a very inconsistent logic. The market right now is very, very emotional. It's not reacting rationally. And this is where, as investors, you really need to make the decision for yourself, right? It doesn't mean that prices can't keep falling in the short term. In fact, markets can remain more irrational than you can remain solvent. And this is why whenever you invest, you want to make sure that you invest in cash that you don't need to touch in the short term, right? If you are borrowing money, you're using leverage and you are putting money, you don't have side cash to prepare for you for a rainy day, you're going to get destroyed, right? These people who take margins and they get margin caught. This is how they get their portfolio wiped out. You don't want to be that person, right? So make sure you always have cash on the sideline. Make sure you deploy them in a way that makes sense, and that look at your financial health, right? Check your income, check your debt, etc. So what happens from now? What is the signal, right? And this is where I will be looking towards in 2026. So on the left, you can see how I weigh the risk of the key risk going into 2026, right? So that's kind of my view of how I will weigh them. So I weigh them according to earnings recession risk, macro and oil risk, AI expenditure ROI, and Fed policy error. Right. So signal number one that I have is the earnings seasons, right? Hyperscaler Q1 results are the moment of truth. We need to continue to see these companies reporting strong earnings and strong profitability. So we got to look at AWS, growth rates, look at Microsoft Azure, Google Clouds. If these numbers in their earnings in Q1 and Q2 are showing that the AI investment has translated into revenue acceleration, then this makes sense. Okay, as investors, we need to see that these AI capex investments translates into ROI, right? They need to demonstrate that in their earnings call. If they don't, then this is going to put more and more pressure on the stocks, right? If they do, then the narrative changes. Signal number two is recession indicators, right? I think there is more and more odds of recessions that's being priced on the poly markets or on many of the reports. So we need to continuously look at employment data and PMI. If we do see any meaningful deterioration there, then the earnings bear case becomes even more real, right? If you guys look at historically when tech stocks, when there's a recession, tax earnings they get cut brutally, right? So for now, the economy remains strong, but if there's any indication, it is important to take a uh take a key view of that. And signal number three is oil in the Fed. We need this conflict in Iran to come to a conclusion. If the every dollar that the Brent crude stays above $100 is going to be inflationary pressure, right? If oil prices remain high, it means that cost of living will remain high. It means that there will be inflation. The Fed will be hawkish, right? I think we initially we were pricing for some rate cuts in 2026. I believe that rate cuts are not really priced in now. And in fact, there's a lot of noise in the market saying that there might be even rate hikes. So this is important. If it happens, the worst case scenario is if we get a rate hike. If we get a rate hike, these stocks will get really, really crushed. And signal number four, again, is the actual AI proof points. We need to see it happening. We need to see real case studies where AI is showing up in margin expansion, headcount reduction, or any kinds of revenue acceleration to the business. Right? The day when all this starts happening consistently is where the sell-offs will get, the sell-off narratives will shift. So for me, there are when there is a lot of noise, when there's a lot of fear in the market, the sell-off can create meaningful entry points. Right? So if you believe, as data suggests, that tech fundamentals are intact, you believe that this sell-off is macro-driven and based on emotions, then the question becomes which names specifically are worth watching. Right? And what I did is I just basically did my own screening in terms of the earnings quality, economic mode, and my fair value, right, that I've done. And these are the five that, again, not financial advice, but these are five that I will think about going into a bit more DCA and accumulating a few shares, right? So, for example, Google, right? Alphabet is something that I'm looking at because fair value I calculated at 280. So there is a chance to enter. Maybe not now because it's still very, very close to that fair value. But Google Cloud is growing at 48%. Gemini AI is at scale. They have about 450 million active users, and Google Search is still super dominant, right? On a forward basis, it's trading at 25 times, 19% between its below its February high, and a lot of analysts are rating it as a buy and a strong buy. Right, I feel like these analysts are a bit optimistic, right? Putting an average price target of $350. But for me, anything under 280 is something that I would consider to start the position. For Nvidia, this is for me one of the safest stocks out there, right? They have 90% of the GPU market share. Nvidia is down 22% from its high. And analyst consensus is about 215. My fair value is about 195. Now it's trading at 160 plus, if I'm not mistaken. So white mode, I believe that there is meaningful chance to enter when the price is this cheap. Broadcom, it makes custom AI chips called XPUs, and these are made for the hyperscalers. Anthropic also plays like a 21 or $22 billion orders with them, right? So again, this is something that's on my watch list. Fair value for me is $380. I believe that's potentially getting. Meta platforms for me, this is my fair value is $630, but a lot of this news, these lawsuits, and the volatility with this stock makes me a bit hesitant to enter at this price. Yes, even though it's declined to about $520 now, I believe that Meta, because of all this noise that's happening, it has a potential to reach about even $400 in the short term. Right, so this is a company that I'll be looking to add, not now, but maybe in the ranges of like maybe 450, 470. Right, I want to make sure that I have a much higher margin of safety for Meta. Right, because if you look at it in the past, it has really declined. This stock can drop a lot. Microsoft, this one is a lot more stable for me, so I've actually started entering a few positions. My fair value is 450. I started buying my shares around 390. And then over the last few weeks when it went down to 380 and even 360, I just find it ridiculous, right? They have like 600 billion of AI backlog. You can argue that Copilot is not the best. That is true, but it has a very high operating margin. So Microsoft is down already 31% from its high. Can it go lower in the short term? Yeah, definitely. It can even go to like 300, right? If the narrative continues and if the Iran war conflict continues, right? So I believe that Microsoft is very meaningful for me. The stock price has decreased a lot. The fundamentals haven't changed. This is where I'm starting to accumulate a bit here in Microsoft really. So conclusion is tech broken? For me, I think the fundamentals are not broken, right? Earnings are still growing over the last quarter, last few years. Revenue is beating expectation. There is truly free cash flows. These businesses are basically categorically different from dot-com era companies. But the problem is the macro environment dangerous. Is there risk in the environment? 100%. Oil prices, hawkish Fed, recession risks, these are real. Especially if you think about AI, if AI is really able to, kill a lot of these jobs, right? I think if you look at Anthropic's CEO, he had an interview that saying that entry level finance jobs, consulting jobs, everything will be displaced by Claude. This is going to make it very difficult for the people who are graduating. So this can absolutely get worse before it gets better. So just because the valuation looks cheap today, which I've shown in the previous slide, just because it looks cheap, you don't want to catch a falling knife. Right? You don't want to catch a falling knife because there can be more and more downside expected. So my advice is if you believe any of these names you believe make sense, you enter, but you DCA, right? You dollar cost average. You don't go all in right now. Don't go all in. Don't put everything. Don't start going to the bank and borrow 100K, right? You can continue to see more and more downward pressure. So is there a valuation repricing? Yes, right. The market is selling off all this hope and the hype. Its market is, historically pricing all these Max 7s as perfection. The five names that I walked you earlier, they are not guaranteed winners, but for me, they pass the screens, right? They have real earnings, they have real economic moat, and real eye integration. So what I'm saying, this is not financial advice again. I'm not telling you to buy the deep. I'm telling you to understand what you're buying. And right now, for me, the data says that the tech story is not over, but it's harder to make easy money, right? The last few years, we made easy money with the stocks. Just buy, bull cycle, increase, increase, increase. This year, 2026, is going to be very different. Okay? It's much harder to make easy money. Great. So if you found this useful, if you want to make sure that I do a more deep dive into a single stock that you really want to understand, please do subscribe. Please comment down in the comment section so that I can understand what's happening. Right, I do cover a little bit of this. I try to upload every week or every 2 weeks, given my schedule at work. So drop a comment below. Which of these five names are you potentially watching? Are you looking at other stocks, for example, AAOI? Or is there any ones that I missed, right? So I read a lot of these comments. So see you in the next video.